I'm thrilled to be here, and I don't know if you guys really understand how special this event is. I've never seen this much energy in a meeting like this, ever, and I've been going to these things for 20 years. So I'm going to spend a little time with you today, and I love to do interactive Q&A. I'm thinking that might be towards the end of when I'm talking, but if I'm saying something that's just, doesn't make any sense, or you want to kind of have a little back and forth, put your hand up, and I'll try to kind of see that and see if we can have a conversation. I think this room works so that everybody can hear each other pretty well. So, I've had fun being here. I actually got to go in a drift boat the other day, and so have seen a little bit about what's going on here in Reading. But what I want to do today is really talk about, angel investing. It's a great opportunity for entrepreneurs, for investors, for our economies, and for returns. And, you probably know each other better in the room than I do. So I'd like to know, how many people here are entrepreneurs or business owners? Put your hands up. Cool, okay. How many people are investors right now? Okay. How many people would like to be an investor someday? More hands, okay. And how many are kind of really the important glue of our startup ecosystem? Which could be all of those things. Okay, great, that tells me a lot. So, first of all, I'm just going to tell you what I'm going to be talking about. And of course, today, this is what Eric and Luke asked me to talk about, so we spent a little time on that. First I'm going to be talking about, how important and the impact of entrepreneurship is for our future, for the economy, and how we might think just a little bit more about the economic development and ecosystem that's so nicely put over together there. Then I'm going to be talking a little bit about what angel investing is and why some people should do it. It's not right for everybody. For those who do it, it's really wonderful. And my remarks will be more for potential angel investors, but I hope that entrepreneurs can get some good information and maybe get a little bit in the head of at least this angel investor. And maybe I should also tell you that while my day job is running the Angel Capital Association, I am an angel investor myself. I'm based in Kansas City, Missouri. I have made 11 investments in 8 companies and 1 fund. So I have a little bit of background that way. And I've actually had a couple of exits, which I'm happy to talk about too, if anybody wants to do that. We'll also just talk about, how the funding works, if you're interested, how you might get started. And then, because I do come from an organization that does stats and things like that about investing, you'll get some of that, both from the view of an angel investor as an individual and from angel groups. And of course, we'll want to talk about the advantages of investing via a group like Shasta Angels. So let's go. First, I'm going to just tell you a little bit about my day job. So the Angel Capital Association is the largest professional association of angel investors in the world. Our members are in every American state and 5 Canadian provinces. And I think Luke has kind of talked a little bit more about, who all. But we do work with angels, whether you belong to an angel group, a family office. Maybe you're just an individual angel who doesn't invest through a group, or you invest online, for instance, AngelList. And what we try to do is help our angel investors get the most information and connect with other investors so that they can do the best that they can, which is really great for the economies and the entrepreneurs that we invest in. And we do that by working on data and research, and you'll see some of that today. We do a lot of education on how to be an angel investor and events that you can get to where you can meet some of the top angels in the world, some of whom are here. We represent angels in Washington, D.C. on things like good tax benefits, but also potential regulations that would stop more people being able to qualify as an angel investor. And we just try to provide the best content and connections that we can. So let me just kind of jump into the meat. So first I'm really talking about, thinking about growing Reading and, the region that you're in. And if you think about it, there's kind of 3 main ways that you can do that, and we've seen examples of that this morning. So the first one, and probably the most traditional, is you can attract large corporations and have them move from somewhere else to Reading. And that has a place, for sure. I'm biased a couple other ways, though. First, you can think about supporting the businesses that are here, make sure you retain them in Reading and help them grow. But I'm most biased to growing your own, helping new businesses start and grow, thinking about the potential of not only unicorns, but zebras. Zebras are the kinds of companies that, are not going to be $1 billion in size, but they are going to be pretty important. They're going to have, 20, 100 people working in them and really help grow the economy that you have here. And I really think about that from a community vitality standpoint. You want to make sure that you're supporting these little blossoms that are going to grow as much as you can, and fostering businesses so that Reading is ready for the future. So this next chart is a little confusing, but the bottom line is this is research by academic researchers and the Kauffman Foundation. And it basically shows that over a 25-year period, all of the net new jobs in this country came from new businesses. And when I'm not saying small businesses, I'm saying new businesses, or companies that are less than 5 years old. The blue part shows what contribution of jobs those new businesses provided over a 25-year period. And the red part shows what happened to net job growth in the US without startups. So you can see that there were a lot of years that without having the startups, our economy would have really kind of tanked. It also includes some years when the economy did tank, so I can't help you there. But so I think you want to, it's really important when you're thinking about growing Reading to understand how important new businesses are, startups. Then, if you really think about it, on top of those new businesses, you want to have a few of those businesses that are zebras and unicorns that are going to really grow after 5 years. Those are those really high-growth kinds of companies that are going to really, take us to some amazing companies, some innovations, some things that are going to change people's lives, but are going to create thousands and thousands of jobs. And those are companies like household words, like Google, like Starbucks, Home Depot, Facebook, et cetera. Those are all kinds of companies that first started with angel funding, then got additional capital later to grow. But these are the kinds of companies that are sustaining our economy. And here in Reading, you have the chance to have companies like that, or some other companies that are just really creating some amazing innovations. So if you're thinking about working with those kinds of companies, I think Reading already has a fantastic start from what I've seen, hearing about your local ecosystem. And I think actually the charts over there are a lot better than the ones I have over here. But really, we need to put to support companies. We need, and in this case, I'm talking about not just those kind of high-growth companies that angels are going to back, all kinds of companies, because you're all going to be contributing to the economy. So I happened to be at a conference last week, and I saw people talking about inclusive entrepreneurship and really supporting all kinds of entrepreneurs. And somebody from the Long Beach Economic Development Commission was talking about supporting a company with microfinancing. I think it was like some kind of crowdfunding. And it was a food company. And so they got I think it was $20,000. And they grew. And they ended up having 60 employees. And the head of that company actually then turned into a mentor and is involved in probably what's the equivalent of Startup Reading, Startup Long Beach or something like that. So it is important to think about all kinds of businesses, even if they're going to be small. But today, the rest of my comments are going to be about the kinds of high-growth companies that we're putting together. We really need to think about all the kinds of support that starts with the entrepreneur and make sure that it's easy to create a business, there's a supportive environment, which clearly you guys have, that really attracts young people, because that's the future of your economy. And it's so cool to see so many young people in the room. So we're really trying to put together support that connects everyone in the ecosystem that we keep talking about. And that's business owners, that's the private sector that we're seeing on all these videos. It is the government and nonprofits like we're hearing about all day today. So just kind of wanted to make that comment that I think you're working well on an ecosystem, and keep it coming and doing more and more things for the startups, because that's where your impact is going to come from. Now I'm going to go ahead and just move straight into angel investing. So I want to just talk a little bit about what it is. We've talked a lot about it today, but I might get into a couple of things that are new to people. So, first of all, angel investors are accredited investors, which is a definition by the Securities and Exchange Commission. It's not a test that you take or anything like that. It just basically says that you have enough money to lose, and you can be kind of sophisticated in your decision making. And it's really based on your income or your net worth. So basically, if you have an income of, I think it's $200,000 a year as an individual, or you have a net worth of $1 million, not counting your house, you could be an accredited investor. They are also people who invest their own money, and often their own time, directly into new private companies. And we see most investments by an individual that are between $10,000 and $50,000 per investment, which might be smaller than what a lot of people are thinking. I talk to a lot of people who think, oh my God, I got to put in $100,000. Not really. You can put in a lot of small amounts, and it doesn't matter. Your return is not going to change proportionally based on the amount of money that you put in. They're all different. They all have their own motivations to invest in companies. A lot of us really care about being part of the ecosystem and helping grow the economy. We want to make sure cool companies are in our own communities, but I'll get into a couple of the motivations later. I think we're the secret weapon for startups in the North American economy. I'll show you a chart later where after friends and family, angel investors put in 90% of the outside equity into startups. Let me say that again, 90% of the outside equity. I think a lot of people think it's coming from venture capital. It's coming from people like the Shasta Angels and unknown people that it's just happening. That's where it's coming from. There's a ton of ways to participate. It's important for angels to manage their risk, and it is a total blast to be an angel investor. Unless you really lose your money. Okay. There you go. All right. And how angel investing works, and you're going to see a couple themes coming from me kind of throughout, so maybe it'll kind of stick. But basically, if I think about the job description of an angel investor, the first part is just to be part of the startup ecosystem, because that's where you're going to find investment opportunities. That's where you're going to interact with startups. And I'm going to get into different ways that you can be part of the startup ecosystem, because you can do it like full-blown, or you can just do the pieces that you really like. Then the next piece is to look at the investment opportunities that come in front of you. So you want to screen them, kind of quickly figure out, does that look like a good deal? Does that fit what I care about? You're going to be meeting with the companies. You're going to be hearing pitches like we're going to hear this afternoon. And you're going to conduct due diligence to really look into this investment. And that really just means you're checking in on, is what the entrepreneur is talking about, does that actually fit in proof? Do these entrepreneurs have a real way to grow their idea and turn it into a company? Are they solving real customer problems? Do they have integrity and things like that? We're just looking for the kinds of red flags that would keep us from investing, pretty much. And then it's about negotiating deals via a term sheet, which is a legal document that kind of defines the relationship between the investors and the entrepreneurs, or the company, and basically how much of the company the investors own. That's through something called valuation, and what are the rights and relationships between the investors and the entrepreneurs. And then the next piece is, what happens after you invest? It turns out that most money is won or lost after we make investments, and we'll talk a little bit about that. And we know as angel investors, some of our investments will be totally lost, and others will get an exit. That means, we've owned stock in your company at some point, and probably 95% of the time, a large corporation has bought that company for a higher value, and that's how angels make money. There's a lot of flexibility in how to get involved. You can be a passive investor. Maybe join an angel group and you're seeing the investments and you're just making decisions as they come along, to anything to be like a full-time deal lead and a board chair and that kind of thing. So understand that there's, just many, many ways you can do this, and there's no one right way. I want to just communicate this as, if you want to be an angel, there's tons of flexibility, and you can just make it right for you. So first thing I want to get across, and I mentioned this a little bit, is the check size as an individual. So what we're seeing is the first time an angel investor invests in a company, the median size is $25,000. That's the check or the wire transfer or whatever that we're sending, and the mean size or the average is $35,000. But let me tell you, there are plenty of angels out there, me included, that are writing $5,000 and $10,000 checks. So there is a way to work with companies, at that level. And then a lot of us actually invest not just one check, but 2 or 3 or 4. We call that a follow-on investment. And those tend to be a little bit smaller. And we do those in companies, either that we see have a lot of progress and need more support from us, or maybe they're getting another investment from a venture capitalist, and we want to protect our position in the ownership of the company and support the company. But the concept I want to get across here is that we're going to be talking about a lot of investment deals that are much larger, because the sweet spot for an angel deal is about $250,000 to $2 million. That's how much the company is receiving. But it's not one person putting all that in there. That's a whole bunch of people writing $25,000 checks, plus or minus, to get there. So, if I'm talking about some big numbers, understand that that's not what one angel is putting in. That's a whole bunch of angels working together to support the entrepreneur. So, another thing to understand about angels, and I'm not going to spend, a ton of time of this, but, angels, kind of fit, and it's kind of changing a little bit over time. But, we're finding that, we're fitting in a little piece of, am I standing in front of it? You can't see that? We're standing in a little piece of kind of the overall funding life cycle for a company. So, first companies are working out of their garages or maybe an accelerator and trying to prove they've got something to, their concept and their idea is going to work. Then they get a little bit more traction and might get, some kind of seed funding. Possibly from a small accelerator. And then you would work in for angel investors are coming in to support companies and really get them so that they're not only proving their concept, but they're showing how they can acquire customers and grow their revenues. And then venture capitalists come in. I kind of think of them more as expansion capital and really help the company get to later stages of growth. But we kind of fit in there. And as we figure out more and more ways for more angels to get involved and connect to entrepreneurs, fewer of them get caught up in what they call the valley of death, where entrepreneurs got funding when they were first starting, but they needed some capital in the middle, and sometimes that's where the angel investors are coming in. If I can make a case for being an angel, and I've actually written an article about this in Forbes, I would put it this way. You want to be in a position to make financial returns with the investments that you're making, and you want to use some part of your overall investment portfolio in angel investing. Typically, that's like 5 or 10% maybe. The rest is in real estate and public markets and things like that. But it's a great way to diversify. It can be a great way to diversify your investment portfolio. The one caution I make is it's really important to educate yourself about how to do it and to learn from other angels so that you can at least not make some mistakes that some of our forefathers did. But what I would really say is financial returns are awesome. But there are so many other fun things about being an angel investor. Meeting incredibly interesting people with fascinating ideas. I think entrepreneurs are the most interesting people on the planet. And they're great communicators, and it's just so fun to hear their ideas and be able to ask them questions and maybe from our joint experience, help the entrepreneurs on their journeys and kind of thinking about some next steps and some tweaks they might be making in their businesses. It's a fantastic way to support what you care about. So it's a way, let's say, you just want to help create great companies here in Reading. That's an exciting opportunity. Maybe you care about bringing in, support. I'm a woman. I'm interested in supporting more women-led companies. So that if I invest in a women-led company, that's something I really care about. It's a way to know you're doing good for companies in the economy, because we know, how important they are to our economy. And I'll be talking about that a little bit. And it's also a way to be involved in entrepreneurship without the responsibility. One of my very favorite angel investors, who's now based in Montana, grew his company, I think, over a 10-year period in Southern California, and sold it to a big materials company. Loved all that. But what he loves about being an angel investor is now he can do the part he likes. He loved starting the company, he loved selling it, he hated the part in the middle, which is the part when you're really trying to grow your company and there's, that's a lot of responsibility, it's a lot of stress. And so this is a way to be involved in entrepreneurship, but it's not for you to grow the company, it's for the CEO and the founding team. It's also a great way to learn, new skills. There's a lot to learn about being an angel investor, a lot of new terminology and technologies and industry sectors and whatnot. And it's a way to take your current skills and apply them in a new way. I thought I didn't know enough about businesses to be on a due diligence team, but sure enough, I knew a lot about a couple of topics, and I was totally the right person to make a couple of reference calls to understand a company. And it's a great way to develop fun and different friendships. You'd be amazed how many angels kind of got to know each other through this process. Now they're going on trips together, and their families are getting together for barbecues and things like that. And so it's a great way to get involved that way. Okay. So to me, this is something that resonates with almost every angel that I talk about. We're really critical to startups in the economy, and let me just walk you through this. The estimates are that angels invest $25 billion every year in 71,000 deals in every state. That includes here, not just in Silicon Valley. There's about 300,000 angels across the country, and as I mentioned, that's about 90% of startups. And if you think about it then, angels are funding more than 10 times the number of companies that are funded by venture capitalists. So if you look at some of the stats that come from the National Venture Capital Association, they had been funding about that same $25 billion every year. Now they're investing in a few later stage unicorns, and it's a little more than that. But basically, they're funding something like 8,000 companies every year, and it used to be half of that. And angels are investing 71,000. So that's a lot of companies and a lot of flowers to bloom, and something as an angel investor, I think a lot of us are proud of. And the other thing to think about, especially in a room like Reading or where I'm from Kansas City, angels really are everywhere. We're not just in Silicon Valley, New York, and Boston. We're in Reading, we're in Kansas City, we're in South Carolina. And there's great ideas and great companies that can happen everywhere. And I don't know that I'm going to have any stats here. Sometimes we have advantages too, because where we live, not only are our houses cheaper, but the companies that we're investing in have lower valuations. And it's easier to hire more people and better ways for us as investors to get involved. So literally, in the data set that we have, 63% of our angels are not in those traditional venture kinds of areas. So it should give you a lot of, I guess, confidence that you can do some great companies and some good investing here in far north California. From a financial standpoint, we're actually finding that angel returns are pretty similar to early stage venture. So this chart here is showing a couple of different studies that were done on different kinds of angel investing, and I changed this chart, so that's my fault. But basically what we're seeing is most recently, angels are making, as a portfolio, are making about 2.5 times their money in an overall portfolio. And actually, my recollection on the slide I was meant to put in here was that early stage venture capital was getting about 2.4 times their money in the same setting. That works out to an internal rate of return of 22%. which compares to exactly 22% for venture capital. I'm going to get to these other things to know, but we're going to be talking about this in a little bit more detail. But the bottom line is, when you think about it on an overall standpoint, the returns are very similar. And in fact, if you think about other ways that you can invest, being it, venture capital, hedge funds, the NASDAQ, angel investing from that standpoint compares at that 22% IRR compares quite well. But here's the thing. The distribution of our returns is super, super lumpy. And that means that, now this is data from 2007 that I guess I trust the most. What it's saying is that 35% of all of our investments lost our money. And actually got, I think it's more than 52% got less than they're invested back. On the other hand, the good news is they did that in 3 years, so we lost our money really quickly. At least we knew, right? Okay. And then, but if you get down to the other end, basically, I think it's, not quite 10% of the investments made 10 times our money or more. In 4.9, if you were between 10 and 30, and 6 years. So it takes, if your investment's in there longer, maybe that means you're going to get a return and that company's going to be successful. Maybe, but there's definitely some examples there. So what that's really telling you is, holy cow, you could, if you're just making one investment, how do you know if you're going to be, losing all of your money or getting, ding, 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 more than 10 times your money. So, you've really got to start thinking about this lumpiness, and what it really means is you've got to think in terms, as an angel investor, of making multiple investments so that you can cover all of these different potentials that are happening. And I'm not going to, this is an eye chart. What I'm really trying to do is kind of explain that when angels are involved and companies are taking in more and more money, as new investors come in, this is what's called a capitalization table or cap table. As new investors come in, the original investors lose a percentage that they own less of the company. So, in this particular case, it's showing a first investor here in the middle, and they were owning 25% of the company. But when new investors came in the farthest over and they brought in another $1 million, that was great for the company. But that made the new investors own 25% of the company, and now the angel investors only own 18.8%. So we're always kind of thinking about all of these different things as we're making investments and kind of calculating where we're going. And so this just kind of takes me to thinking about the key things that angels need to know in investing. This particular picture actually came off of my camera, and this is showing a couple of experienced angels who are putting together what we call a fundamentals of angel investing course for new angels. So kind of get to what we're talking about here. So the first thing to know is we do need to diversify our portfolios. And that's by number of companies. It doesn't necessarily mean you have to have diversity between industry sectors, although that's perfectly fine if that's what you care about. But what we've really found is, there's a couple of opportunities on how many investments you make to mitigate your risks. So taking some data from the same returns data I was showing you, a former angel investor named Luis Villalobos did an analysis on that, and he found that if you make 6 investments, you have a 50% chance of getting your capital back, or one times your investment. If you make 12 investments, you have a 75% chance of getting the 2.6 times return that I was showing earlier, or 75% chance. And if you make 24 investments, you've got a 90% probability of that same 2.6 returns. So kind of different people are going to react to that differently. So, a lot of people basically say, okay, so I need to make 10 or 12 investments, and I'm going to be have a pretty good chance of getting my return. That's how a lot of people think about it. But there are some people who then take it down to, okay, if you get a 95% chance, I think you have to make something like 52 investments or something like that. But that's kind of a declining probability for me. So, if you're thinking about making investments, it is possible to mitigate your risk and have a chance of good returns with a smaller number of investments. So, you do need to kind of think about your portfolio strategy. You need to, when you're starting to think about being an angel investor, it's really important how much money, what percentage of my investing am I going to be putting in angel deals? And it's probably, if you're married, you're probably going to sit down with your spouse and go, okay, how much are we willing to risk here? And a lot of people do come up with, somewhere between 5 and 10%. And maybe think about, not only am I going to support, let's say, 10 companies, that's where I came out, I'm going to want to think about that overall number. So let's say I just made the accredited investor definition, and I can have $1 million in net worth. So maybe I'm going to invest a total of my life of $100,000. Then I'm going to think about making, investing, 20 checks, so that'd be 10 or more companies, and supporting them at least twice when they're doing well. So I'm going to take the $100,000, and I'm going to think that I'm going to divide that by 20, and if I remember right, that would be $5,000. So I'm basically thinking about writing $5,000 checks in each of these companies. And then, thinking about how many years you want to do that over. You can do that in a few years, or you can decide, hey, I'm going to do that in 10. Either one of those is fine. And next you're going to be thinking in your portfolio strategy, well, what companies are, fit my preferences, and what are some smart practices to think about that. So to maybe help you think about kind of investment preferences, let me tell you about what mine are, and which would be totally different from Eric's or other investors in the room. So when I'm thinking about companies, not only am I thinking about, do they have a good market? Is the entrepreneur, really awesome? And, looks like the team can turn this into money. I'm also thinking about, hey, it's my money, so I want to have some fun with that. So for me, I want most of my companies to be based in Kansas City. So I think here that would be in Reading. Next, I want to make sure I understand the company's business, their product, or I do some investment through angel groups. I want to make sure somebody else in the room that I trust, understands that business and is probably investing. I do really care that I've got a strong founding team, they're passionate, they have a lot of integrity. For me, I also want to make sure that the company is early stage, but they have some level of market traction. Maybe they've had a couple customers come in, oh man, they're going to solve this problem we've been trying to resolve for 5 years. And then for me, it's kind of a little bit unique. I want to make sure that my check can actually make a difference for the company. So if the company is raising, $500,000 and I'm part of $200,000 going to the company, I feel like that's making a difference for the company. Whereas if somebody comes and says, hey, this is a $5 million raise, and you're gonna invest in a company that's worth $20 million, my little $10,000 check that's going into $100,000, in my view, doesn't make that much of a difference. But for others, that's not what they're going to care about. They're going to think, wow, that company's making a lot of progress, and I like that that's going to mitigate the risks. And then for me, it's also the deal terms make sense, and the due diligence checks out. And I also want to make sure that some of the companies in my portfolio are women-led. Of the 11 investments that I've made, 5 of them have been in women-led companies. So I've tried to make sure that I do that. But the bottom line is, this is your own money as an angel. Everybody's going to do what they want to do, and it's just do what's important to the angel and their family. So if you're an entrepreneur, know all of this calculation is or should be going inside the head of the angel as they're thinking about your business. Sometimes they're not going to invest in your business because it just doesn't fit their thinking. It's not because you're a great business. It's just you've got to be a match in what you care about. And sometimes that means we miss out on some things. Because I already said it has to be in an area that I understand. I figured out, I started fainting at the sight of blood, I think in 2nd grade. And that pretty much means anybody who's starting to do a lot of healthcare and life sciences stuff, and they're pulling out the blood and they're cutting up the mice and stuff like that. I don't want to have anything to do with that. So, and I don't understand it. But that means I have missed out. I missed out on a deal in Kansas City where I knew the entrepreneur was awesome. I mean, incredible that I've ever seen. It was a pet care pharmaceutical. And they had an IPO in 9 months. I missed the party. They actually had a party at the local really cool jewelry store to figure out what they were going to do with parts of their returns. I was not there. So, as we're looking for deals, we're not only thinking about, we're thinking about all of those preferences, but the first is, is it a good entrepreneur and company? Does the team or the advisors know how to sell innovation, how to grow value? That can be a first-time entrepreneur for sure. It's great when you have entrepreneurs who've done it before, but most of the entrepreneurs we see and invest in, and I bet that's true here too, is they're first-time entrepreneurs. So, do they know how? Are they coming from an industry they know, or are they bringing on some advisors that can kind of help them think that through? Are there customers or potential customers who are really going to buy the product? And that's a lot of the checking that we do and a lot of the questions that we ask about. Is there a large market opportunity? I think most of us would say, is the market for this product at least $500 million? And can you see some true exit possibilities? Have they talked to some potential companies or thought about some large corporations that would eventually acquire them in some short period of time? It used to be we were looking for that in a 3 to 5 year standpoint. Now I think you'd hear more, 5 to 9. I've certainly heard a couple investors say, the best company they ever invested in, they held the stock for 14 years. But most of us are looking for it something shorter than that. And then, of course, is the deal good? So are the terms and the rights of the investors and the structure of the deal what that investor cares about? A lot of our investments are in preferred equity kinds of deals, but more and more we're starting to see what they call convertible notes. So we all make an investment, but we don't really know what the valuation of the company is. Technically it's a loan, but it's going to convert to an equity round in the next round. And a lot of us, me included, not super excited about that, but we're investing in those companies anyway if we really like those companies. And we've got some stats that certainly show that's what's happening to angels. Here's an example of how you might rate a company, and it's going to be different for everybody. But in this case, we're saying this particular angel would put 30% of their consideration on the management team and their ability to grow the company, 25% on the size of the market that's there, another 15 on the product and the technology, and then smaller amounts on everything from the competitive environment to really having great sales channels, marketing, and we also think about, well, are they going to need more funding? Because that adds a lot of risk to what we're doing. So and how long it's going to take for the company to get to a place that we need. So those are all kinds of things, and so we might kind of have a little sheet that helps us think through all of those things. It's another way of looking at the sheets, I think, that are on the back of the companies that we're going to be talking about, the one-pagers. So there's certainly other ways to do it. And then look at these cute puppies. Okay? They're all cute, right? And so, the issue is we see a lot of entrepreneurs, and it's really important. And it's great to negotiate good deals and, conduct good due diligence, but can you really tell which one of these puppies is going to be best in show? You really can't. And the same thing happens with entrepreneurs. And somebody we think is super exciting, stuff happens. And so we do need to, that's another reason we need to take the portfolio approach to what we're doing, because you just, you don't know. And on top of that, we need to think about the fact that angels make or lose kind of most of our money after we invest. And a piece of that is, have we saved back some money to invest a second time in a company? And then, need to keep track of our cap tables and our dilution. But we really need to think through, as angels or maybe as parts of angel groups, how do we help those companies? Are we mentoring them? Are we on their boards? Are we helping them find follow-on rounds? Everything that we can do to make the company successful based on our own expertise is also going to help us with our returns. Now, I am going to show you just a few stats to think about. This is a study called the American Angel that looks at who are angels, how much they invest as individuals, and why did they become angels. So just a couple things to think about. We're finding that angel investors are mostly male. We got to about 23% of angels are female at this time, and that's actually semi-exciting because if we compare that to what's happening in the venture world, that's like maybe a 10x in what's out there. And then we're finding that angel investors by age, I think the median age is 57. But we're finding a lot of angels that are getting started at 48, and we're seeing more coming in younger and younger if you have that opportunity, and a few sticking around later into their years. From an investor experience, you've got angels who are out there who have been doing investments for 40 years. But we're seeing, a growth in angel investing as an exciting thing to do. 25% of the angels in the American Angel study had been investing for 3 years or less, and all kinds of experience that's happening in there. From the past to being there, a lot of angels are entrepreneurs, business owners, and past executives, but there's a lot of different paths that you can get there. We do find that if you've been a business owner before, or maybe you've been at a C-level type executive with a P&L responsibility, you might have a little bit more to offer as an angel investor and have a little bit more success. But there's so many different paths that you can be there. And I made that comment about women growing. The exciting thing is that 30% of the angels who had been investing for 3 years or less were women. So we're going to be seeing over time that's happening, and then we're going to see more young people, more people from all kinds of regions, more people of color. I think you're going to see that over time, and that's going to result in more support for entrepreneurs and some better decisions in our investing. And just getting to the comment about having a portfolio, we find that angels are growing their portfolios, the number of investments that they have as an angel over time, from less than 5 with 3 years or less, but by the time they get to 18, they might have more than 30 investments in their portfolio, which is exciting. Maybe this is a good one if you're thinking about being an angel, and it's like, where am I going to find this deal flow? So what we're really finding is that a lot of them are finding them from angel groups or being part of an online platform. But there's a growing, there's quite a set of them that just get into it because they know some entrepreneurs and they heard about a good deal, or they have friends that have been making angel investing. They've heard how exciting it is, and they get involved and get introduced to the entrepreneurs that are in their networks. Certainly, we find a lot that are just part of the ecosystem, and they're going to the accelerators. They're going to events like this. I'm going to skip that one. Okay. The other thing I want to talk about before I kind of wrap up is thinking about stats for angel groups that come from our Angel Funders report. So what we're finding is that the average size deal from ACA members last year, the median size was $2.5 million. Again, that's what the entrepreneur received. But there's quite a variety in the size of investments that are there. But 77% of the investments were $3 million or less. That's kind of an angel deal size. Industry sectors were kind of all over the place. We're in information technology and healthcare are always the biggest ones, with healthcare deals being larger. And typically that's in medical devices and things like that. But there's plenty of possibilities in consumer and energy and manufacturing. So and we invest pretty similarly to venture capitalists. We do, if you think about the timing of the of the deal. More than half of our investments are in seed, which is our angel deal, and then they move on to the next round where venture capitalists typically come in. It's called Series A. But what we're finding is that angels are sticking around. They're making that early stage investment, that they're sticking around and making more and more investments. And I'm in a region that doesn't have a lot of venture capitalists, and so we're sticking around because we're the only ones who are going to fund these companies. So we're getting that done. And for you think about the valuations of the companies, we're seeing the median across the US was $6 million last year, but a huge range. I'm going to go through these pretty fast. I'm going to be providing this to you guys so you'll have the deck. So if you want to share it with people, they'll have that information. We're also seeing a lot of variety between regions. On the valuations of the companies. So the New England and California, which really means Southern California, are more in the 6.5 or 7.5 range, where the Great Plains, where I'm from, it's like $4 million. So there is a good range there. And if you think about the size of companies that we're investing in, the average is 11.4, but really 75% are 10 people or less. So we're investing in truly small companies. And then just thinking about total dollars invested per group per year, the median size is about $1.7 million. And I think that's I'm going to get the number of deals wrong, but there's quite a range. So you've got, a few that are doing, $500,000 a year, and you've got some that are doing more than $10 million a year. So finally, I want to talk about the advantages of joining an angel group. And this picture I'm showing you is from the 20th anniversary of the Sierra Angels, who are in Lake Tahoe. And they had a party to celebrate, and the table they had there among the redwoods, or the big trees, I think it fit 150 people, and we were having a lobster boil. And it's just kind of showing how exciting it is to share that growth with so many people. The food was good too. So if you think about really being part of an angel group, let's talk about the financials of it first. So we've already said the median round size for the companies is $1.2 million, and on valuation of $6 million. And as individuals, we're writing checks of $25,000. So those kind of things don't go together. We have to figure out how we're going to work together. So most angels are kind of working together to team up. They can do that just on their own. They can do it individually. They can go with accelerators and go to angel groups. And at least we're putting our money together in maybe an average of $215,000, getting closer to what they need. Then we're trying to figure out, how do we pair up with other investors, angel groups, venture capitalists, private equity, family offices, to come up with that $1.2 million that the companies need. So we're seeing a lot of syndication, and in the case of ACA members, almost 3/4 of those deals had more than one angel group, and often 5 or 6. And we've been figuring out how to, make that work through things like NSYNC. And then if you just think about being an angel, there's a lot of work there. So if you're doing it on your own, you've got to come up with your own deals, you've got to read business plans, you've got to do due diligence, you've got to think about the legal costs. Instead, why not work with an angel group where you can share the work, you can have a whole variety of expertise, you have standardized processes, you've got deal flow coming and you don't have to do any of the work. You can choose the deals you want to be in. You can meet really interesting people, you can learn from other investors, and the one I kind of like is you can be anonymous if you want to. So if an entrepreneur is coming to you and looking for capital, you can send them to a website, or you can send them to Eric, and then you're not kind of involved, because I know that I get a lot of calls from entrepreneurs looking for money all the time. So that's kind of one thing. The other thing is you can be with a diverse group of people, and there's all kind of proof that better decisions get made when you have diverse people asking questions and making decisions together. Not only do you make better decisions, but some research from the Harvard Business Review even says venture capitalists have found they actually have better returns and exits. So that's another reason to work with an angel group. And angel groups have kind of put together a process So what happens is they'll have an opportunity come in or a referral online, and then they'll have somebody pre-screen it. Does it fit our requirements? Like, is it in Reading? Is it in the couple industries that we say? And then they have a screening committee do more work on it. Then they bring it to the group by email sometimes via a meeting. You know, are you interested in this deal? Maybe the entrepreneur has made at least kind of one pitch to the group and they've been able to ask questions like we will do this afternoon. They find if there's, you know, somebody in the group who's willing to lead the investment and start getting some alignment on what the term sheet will look like. They do the due diligence and just do a lot of negotiation and make sure they can bring in a lot of other investors to do it and syndicate the deal. So very quick on getting through that. And I'm not going to comment too much on this because this is from a group from Boston, but it does show that you do go from having quite a, you have a lot more proposals coming in that you actually invest in at the end. So I think, Eric, you were saying you get something like 30 investments a year and you make 1 or 2. So that's basically what happens here. Finally, just how to get started in angel investing, and I'm going to take a couple questions after that. So, if you're thinking about it, make sure you meet the accredited investor standards. Educate yourself as much as you can. There's tons of books. There's events like this. There's really successful entrepreneurs who are and investors who are putting out great blogs. Talk to existing angels and get advice. Join an angel group or an online platform and develop your investing theory, like I showed mine in Kansas City. And if you're part of an angel group, even when you're new, ask a couple of questions. See what experienced people are doing, but then start asking questions yourself. And then finally, when you're ready, you can write a check. And I think it took me 7 months to write my first check once I started doing it. I think I was pretty average. So, it doesn't just happen right away. We do have some resources available for you, whether you belong to Shasta Angels or not. Some of them are available for you. We've got webinars and videos on how to make angel investing. We've got research, and we've got all kinds of articles. I used to write a column for Forbes, and you can find it on our website, and there's stuff in there like how to get started, the job description of an angel investor, angel investing in small towns, and certainly everything from how to do valuation and due diligence and all those kinds of things. So my time went a lot faster than I was thinking, but it's really been fun to be here with you all, and right now I guess I'd like to go ahead and take questions from entrepreneurs or investors.